Alrighty, thank you everyone for joining us today with these VC Insights with Andrew Mitchell and Wesley Goetson. So this is being recorded. Once the event is over, we'll be sending a link so you can rewatch the event. And let's engage in the chat. If you feel like dropping in more questions, feel free to do so. Anish, passing the mic to you.
Cool. So my background was actually running growth of different companies, mostly startup companies, mostly B2C companies, both full-time and as a consultant for about 11 years. I spent 11 years in San Francisco, moved to New York about 3 years ago, and then just sort of began recruiting for some of my clients as well, kind of with the whole idea that people who've actually done in-house operating roles and have led different functions, we'd be a better fit to recruit than someone who's never done the jobs themselves before. So fast forward a few years later, I actually cut out the growth consulting and growth work altogether and built a firm just focused on hiring the best people across growth, marketing, product, analytics, and design for a lot of fast-growing companies. As of the last year or two, I would say a majority of the companies we work with tend to be in the D2C, direct-to-consumer space. So that's why this chat's really exciting, because Andrew and Wes are behind a lot of the most popular D2C companies.
All righty. Now on to Andrew.
Yeah, hey everybody, thanks for joining us. Glad to be here. So I'm the founder of Brand Foundry Ventures. We're an early stage, consumer-only venture capital firm. Our mantra is that we invest in next generation consumer brands that we hope you can't live without. We're lead investors at the seed stage, which is either pre-product or right at launch. Typically cut a check around $1 million and ownership around 10%. Geographies, we typically track the coastal big ecosystems like New York and LA. We have a presence in Austin. We like Nashville and emerging cities like Boulder and so forth. But anywhere in the U.S., we're comfortable meeting teams and building businesses. I myself got into this business about 2013 formally, after about a couple of years as an angel investor, and then prior to that, I was a consumer packaged goods entrepreneur. So I've been in consumer for about 20 years and still love every day.
I'm Wesley Gottesman, and definitely the least impressive person on this call, so I'll keep it brief. But been an operator at a couple of different venture-backed startups, ranging from Drew Brees' apparel line 9 brand to Fleur, which is a digitally native perfume company. Met Andrew about 3 years ago and decided to sort of come on board just to learn and intern with him, and eventually made him bring me on full time. So I started about 1.5 years ago full time with him, and have been just looking at deals and learning from Andrew ever since.
That's awesome. I've got to, before we even get into that, I've got to know what it's like starting an apparel company with Drew Brees. Was he actually, involved? Was he, how deeply was he involved? Like, what was that even like?
He's like one of the nicest guys on earth.
I would hope so. My entire world would be torn upside down if I found out like Drew Brees was a jerk.
Yeah, me too. I mean, I grew up the biggest fan of him, and so the opportunity to work for him was amazing. And his involvement was like almost scary high level. Like he wanted to like touch and feel every single thing we did. And he had so much, I think, like relationship with his fans that was on the line. And he really wanted the highest quality, best things possible. It was definitely a difficult relationship given, he's a football player, not an entrepreneur. So the amount of time he could dedicate was tough. But it was just an unbelievable experience to work with somebody that's that generous and that thoughtful.
That's awesome. Okay, cool. Sounds like a positive experience.
For sure.
Cool. So this is actually a series where we have conversations with VCs, talk about all your sort of burning questions. Everyone who registered for this call, we asked all of you to send in a question. We ranked out the top 9 questions. that based on, which ones seemed interesting and which questions people asked multiple times and so forth. It's a rare glimpse into the life of, what VCs look at in terms of which founders to back, what companies to back, what they look for in talent, and even what the day in the life is, or if your goal was to become a VC one of these days, how do you actually get there? Yeah, so hopefully we cover a lot of different areas that help you get a much better insight into all of that.
Alrighty, let's start with the questions.
Cool. Luckily, I was able to get a quick chat in with Andrew and then with Wes previously, as they told me a little bit about this. So sorry for making you repeat yourselves, but how did you shift from being an in-house operator to actually becoming a VC? And also, what's the difference that you've noticed in terms of what you needed to be really good at in your previous life and what you need to be really good at in this current life?
Yeah, I mean, everyone's story is different. What I can say is that I was fortunate to be an entrepreneur, had a decent exit right around 2010. And that afforded me the opportunity to invest off my own balance sheet, which I decided to do, which is either a smart decision or not. But, it's turned out to be a pretty good one so far. So I'm not going to have a perfect answer, but that's, most people either work themselves in through an internship or, obviously just connecting with various people. It's very much a people business. I'm sure we'll touch on that with questions further down the pike. I mean, look, what overall for us, our mindset is, we're not ego driven. We're not the right answer all the time. What we have developed is pattern recognition. And so I think a lot of the good, bad, and ugly of those operating experiences for me, I've used to translate in my decision-making for, investments. Some of that has also changed based on consumer trends and business models and so forth. But at its core, I've always been religious about, a product and or gross margin story. Building meaningful businesses that should have the ability to, fund themselves. Obviously, if you're investing in building a big business, you're going to have to take on venture capital money. So, not to say that we're focused on profitability, but the point is let's invest in something that has the opportunity to grow. Which also could factor in enterprise value and so forth. The second thing is a lot of the thesis has been digital first. In the early days of kind of 2010, 2011 with the Warby Parker and the Harrys and just this kind of new e-commerce 2.0, we talked a lot about, or we all saw a lot of the, taking out the middleman. And that's fine. That was a great kind of 3-year run. And then everyone was, Warby Parker for X or, away luggage for Y. It's a little diluted, but I think the good news is e-commerce has grown every year. Businesses that maybe started as retail have leveraged e-commerce to extend their business and reach. Things like AWS and Shopify have, allowed, companies to thrive and be built easier than once before. And so there's a lot of good energy propelling a lot of, brands and really, frankly, founders forward, which is the goal. Like, we're rooting for everyone, whether we invest in something or not. So to round out my answer of, skill sets, I think, we always lean on operators who have, seen, a lot of things of a business. They've managed HR, they've pitched a retailer, they've, built a website. We like those type of people. You don't necessarily have to have domain expertise, but if you're building something, that's what we like to see in a skill set. And again, like some of our core beliefs in terms of how we assess a business and the likelihood of a success, high product margin, gross margin, a digital first presence. Are you creating something that's truly differentiated, product, service, or otherwise? And, what do you want to build and for how long?
Cool. It makes a lot of sense. And then Wes, you have a little bit of a different story. Obviously, Andrew built the firm. And then, you might be able to give a little bit of story on how do you actually get to work with someone like Andrew who built a popular firm?
Yeah, I think everybody's path into venture is different, and there's definitely not like you do 2 years of this and then you do that sort of storyline. Mine definitely was, a weird bumpy road into meeting Andrew. But I think that the best way to get into venture capital is probably to make a bunch of money yourself and be able to deploy it. And if you can prove out a track record, you can start doing it for other people. Andrew's definitely a victor of that storyline and has done a great job of it. And I looked at that and sort of admired it and was hopeful to get and learn from him, that hopefully someday I could, do what he has done. That's turned into a full-time job that I've been able to sort of keep that mentorship, and I've been thrilled to do it. But it's definitely not something that I ever intended, at least initially, to do after business school or do after, my stints in product.
Cool. Makes a lot of sense. And like, have you learned that back in your previous world of, running product, being a part of a bunch of startups versus your current world of being in-house at a VC firm, like, were there some different skill sets that you had to learn along the way that you were like, oh, wow, this is completely new. I got to become really good at this area?
I think what's weird about venture capital is you've got to be really good across a lot of different areas in order to speak competently to entrepreneurs that are going through incredibly different things. So I've been super lucky to be able to learn from Andrew, who has operated a business, across entry to exit, and sort of see how he views things, and then bring on some of my experience inside of, different aspects of a business to try to provide value. But the things that, I thought I would be doing are probably a little bit less, as far as like, yes, you need to be able to understand a P&L. Yes, you need to be able to read financial statements and balance sheets, but it's not like you're able to accurately forecast 5 years from now a company that is coming up with a product tomorrow. So it's a lot more of the sort of softer skills, a lot more of being able to like foundationally understand where people are going. And then if you can sort of cognizantly recognize all of the different aspects of a business, you're definitely in a pretty good shape.
Cool. That makes a lot of sense. Thanks for that. What part of your job do you love the most?
Like I said before, this is a people business. It's just awesome to meet and get to know other founders or all the founders that come across and through our network, other VCs we've known and built relationships with for the last decade. It's really cool. I mean, and some of the ideas and businesses you see are things that won't come into the forefront or the wide consumption market for years. And so you're on the cutting edge of technology, even if you don't invest. I mean, a better way to, manage garbage, or, a biotech business that is way over your head, but, you spend 30 minutes with the founder. I mean, it's incredible stuff. So being on the forefront of, innovation and meeting people is really, really fun. And I would also add, from the limited partner, which is the people that invest into our fund, the ability to meet these type of people, because our limited partner base is mostly family offices and high net worth, just incredible people that, you sometimes scratch your head and say, how did I get invited to the 90th floor of the World Trade Center to meet X, Y, and Z? And, it's because you've invested so much time and energy and obviously built a track record. So all in all, it's the people, and it's a lot of fun. That's
awesome. How about you, Glass? Any other thoughts?
I'll give the James Carville from Old School response and just say he put it perfectly.
That's awesome. Yeah, and I get asked a lot, like, what's it like going from being in-house and running kind of marketing and growth for different companies, or even as a consultant versus recruiting? Because it's a very rare path that people go from functional skill set to starting a recruiting agency. And I'll kind of tell them, I get to kind of interview the smartest people out there. And then I actually get to learn the inside stories of a bunch of companies, because people will very freely give up exactly what's going on within their company, why they're looking to leave a particular company, what's working, what's not working, whether their products are actually selling, whether the margins are terrible, whether they actually believe whether their company that they've been a part of for multiple years will actually exit or will really succeed. So that part's pretty fun. You get to play with a lot of insider knowledge right there of early stage startups. So and then also see how the sausage is made a little bit more deeply. So that part's been pretty fun on our end as well. So I think all three of us seem like being able to meet incredibly smart and incredibly kind of successful people regularly and learn from them. I guess kind of fits into what drives all three of us.
Sure.
How has your current consumer investing perspective shifted or changed from when you first entered the industry? Obviously, you guys were at the very kind of early stage of D2C, getting some of the really big early winners. Has how you approach viewing some of these companies, looking at their pitches, has any of that changed or over time, maybe with kind of a little bit changes in the D2C industry, or really similar kind of mechanics of how it all works?
Yeah, I think what still holds true today is the need for true differentiation and be able to answer the question, what customer are you building to or building for? And, essentially like what's the ethos of your brand? And I would also say that D2C, right? So a lot of trends, and e-commerce obviously with COVID is doing exceptionally well, but it's always been trending at least kind of 4 to 5%. I think what's changed is over the last decade, probably less, all in on D2C. Like we will always look at and still invest, which we have recently, in direct to consumer e-commerce businesses, multi-brand or single brand. With that said, it's a lot different than the early days, 2010 through 2012, where like, oh my gosh, everything is D2C because every category had yet been expanded into. Luggage, mattresses, and that was really fun. I think today it really, it's a part of the story, but we've also spent a lot of time in new models and in new categories, chasing, different customer segments. I mean, we've been focused more recently on, say, elderly care and the baby boomers. I think there's a lot of opportunity in death care, funerals. I mean, again, there's still a lot of existing categories that just haven't been transformed, if you will. So I think there's a lot of upside there. So I think business models, we're not all in as much as we were just on pure e-commerce. And I think that certain categories, health, wellness, pet, dental, those kind of ebb and flow with changes in consumer behavior. So product differentiation, or just pure differentiation if your product, service, or whatnot. And who your customer is, those have not changed, but the categories and the way you deliver that has definitely changed to some degree.
Cool. That makes a lot of sense. Is it safe to say you're looking for industries and potential companies that are sort of taking on areas that haven't been fully fledged online, and companies that are trying to bring that online, kind of like you mentioned, some like death care or stuff like that?
Yeah, I mean, the best thing for us is let's just walk through a couple examples. So one of our portfolio companies, Small Door Veterinary. So trying to reimagine veterinary care. The service that we provide, pretty much the same. Obviously, we want to do it with a brighter smile and more care and more fun. But the business also brings in, really low touch technology where we've got, an app where you can upload your pet. So Buddy the dog is uploaded in your, you can track his medical records, vitamins, all these other things, and you can get alerts. And, that's very much how the world works today, even at a kind of a low base level. You reimagine care, and then you scale the business. So I think that's just an example of, a very large category that continues to evolve, yet it's not necessarily revolutionary, right? I mean, it's very much brand first and creating a better experience and transparency, frankly, for the customer.
Makes a lot of sense. Thanks for that. How do you spot founders with potential but lacking relevant experience? I'm sure some of your early wins involved founders who hadn't built yet kind of these like household brands. So like, what can they do to show you, yeah, you don't have this huge track record, but man, you have the capability to build an amazing company?
Yeah, two things come to mind. The first one is we don't have a thesis around, second time, third time founders versus first time. We have plenty of first time founders that we're involved with and have created amazing businesses. The second thing is you don't necessarily have to have true domain experience, meaning if you're launching a beauty brand, you don't necessarily have to have 10 years of beauty experience. And we've got a bunch of those as well. I think that the one thing we look for is, if you don't have it, does your co-founder have some experience? And again, the experience doesn't have to be beauty to beauty. It could be consumer packaged goods to beauty, just as an example. The know-how of how to develop a product, how to, work and manage a supply chain, what to look for on the P&L and margin structure. So, I mean, in a perfect world, we've got an operator and a visionary strategist, and usually that person, the latter person, is more on the marketing side, and that's a great fit. So, relevant experience is helpful. It doesn't mean it's an all-in type of thing, but and the funny yet serious thing I'll add is, there's a lot of signals that we're looking for, and if you've got low energy or reading off a deck, it's not going to help your cause. Like we want passion, we want emotion. We're not saying we need the sales pitch of a lifetime, but these are signals. Do you know what you're talking about? Do you have a sense of confidence? We won a deal last week, and we literally issued a term sheet after a bunch of diligence through Zoom. Never met the person, which is not something we typically do, and decided to move forward for a lot of reasons. But, when I said, why do you really need $3 million? I mean, she pounded the table and she said, this, and this. I'm like, damn, that's good. Confidence is good. So just another example. Wes?
Yeah, I think initiative and energy are two things that I definitely look for when I talk to a founder. The energy piece is huge, especially since we do meet with so many entrepreneurs, that if you can come and make me excited that I'm a part of this pitch, it's definitely like a step in the right direction. And then initiative is a thing that I think oftentimes is overlooked, but a lot of people sort of complain about things like VCs not responding to cold emails. But to me, if you take the initiative to reach out to founders we've backed in the past and say, how is it working with them? Can you introduce us? That's a really strong sign that somebody is willing to, break the conventions of just like sending a cold email and figure out the best way to connect. So I look for that sort of initiative, and, it's not just a pitch deck, but they've actually, put something in front of customers or sold a couple of, there's a business we invested in that's launching soon. And they basically ran a mini fake company to prove out that a market existed and prove out that a branding can resonate in that market before they hired an agency, before they went out and raised money. And now we're super excited for what they're going to be doing now that they've had the resources to really expand on that.
Yeah, absolutely. That makes a lot of sense. We come across similar stuff too, where people have perfect resumes. Literally all the popular brands, went to the right school, went to the right MBA school. And, 15 minutes into a conversation, I'm just noticing I'm checking my phone. Like I just lose interest listening to this person talk. And it's because they're just like, well, I did integrated marketing and I did this and I did that. I'm like, all right, you're just reading bullet points, like show me that you actually cared about what you were doing. Like where's the spark? Like, are you just looking for a job, or do you want something that's going to be exciting? So if that's a note for you, it's not just when you're pitching, like, one of the top venture capitalists in the world. Even when you're applying for a job, like show some passion with whatever you're doing. Otherwise the person on the other side is going to notice. And on the unfortunate side is they're not going to give you that feedback. Like when someone is really boring in a job interview, I'm not telling them at the end, like, sorry, you just weren't compelling. I was really not interested in what you had to say. So unfortunately, like, you really have to learn that yourself and like really get some passion, get some excitement about whatever you're doing. Otherwise it's going to show.
Just to jump in, I think taking like some control of the conversation. Two people meet on Zoom or a phone call for the first 30 minutes. There's probably been a deck shared ahead of time. I mean, make it a conversation. I mean, we don't need to go through the deck. We want to get to know you. Let's keep it simple. It's probably 30 minutes. Let's get to know the team. Let's talk about differentiation. Let's talk about how you're going to acquire those customers into your business. And, we'll talk about the financing the last couple of minutes, and then it's 30 minutes. Could it go longer? Sure. But I think what's just an interesting thing, and instead of just saying like, hey, like, how do you want to do this? Just take the reins. Hey, let's have a conversation. Let's keep it human. And here's what I'd like to accomplish today. And of course, also ask some questions. Is it a good time for you? What are you looking for? What excites you? I mean, I know it can be stressful with a pitch, but again, we're a human just like the other people. And hopefully we want to team up with founders. We're not, Jesus Christ just because we got a venture fund. I mean, maybe Wes is, but not me. But just keep it human, and just make it fun.
Yeah, absolutely. People get scared off a little bit by the perceived power imbalances, and that they got to be quiet, like they shouldn't make a mistake. When I think very regularly, it's better to like make one mistake as long as it's alongside, 4 other things you say that aren't a mistake, and you're just putting it out there. Because every founder is going to make mistakes. You want someone who's willing to make mistakes, not just be this perfect person who's sort of scared to do any little thing. So yeah, if that's good advice for any of you guys out there, like come with some excitement, and don't be scared to turn it into a fuller conversation. Not just a one way where whoever's on the other end is asking you questions, because they're going to notice. Thanks for that. I think that's going to be really valuable for a lot of people. If you give one piece of advice to pre-revenue consumer product companies, what would it be?
So 2 things come to mind. One is on fundraising and one is on the business itself. Let's talk about the business itself. So we're seed investors. Everyone's got a different interpretation of what seed is. Too early. We've invested $3 million on a deck. We've also determined that certain things need more time. And so maybe we invest, 3 months into launch. So there's no perfect answer. What I will say is that if you think about how do you de-risk as much of the business for that seed investor or that early investor, how could you do that? So a couple examples would be like, having a co-founder established in a small team. The second thing on the product or service could be, hey, look, here's V1. It's V1, but I can at least show you something. And if it's a product, it's a prototype. Being further along, like having your supply chain. If you're in the nursing shoe business, like Clove, doing a lot of the work ahead of time. Hey, I've got a supplier. I've got a mold that with this funding I can purchase. Like just create a little bit more. Advancement of the business de-risks it for the investor. That is super helpful. And again, we're just one example, but if you came to me and said, hey, I'm launching a beauty brand. I don't have the formulas, in the lab prepared or in progress. I know that takes at least 60 days. Then you've got compatibility and stability testing. The point is it's a lot of time. So try to advance yourself as far as you can. We definitely know that resources are limited and you can't just go invest $100,000 into a mold, but like do a lot of the legwork. Hey, that's great. You've got a supplier in China. Tell me about them. Hey, like it's awesome. You've identified a web marketing business. Oh, we've heard of them before. Things like that could be helpful. The next thing that's important on the investor side is, really the amount of money. Just doing the legwork to understand as best you can, who are the lead investors. I mean, if you're raising $250,000, again, that's fine. It's probably not Sequoia. It's probably, you're probably better off going to people in that specialty, industry. I mean, sure, if you have a leg into Bessemer or Sequoia, then great, have a conversation. but here's the point. It's all about conversion. If you're a consumer packaged goods business or technology, like come to Brand Foundry. The chances of converting are higher than going to a generalist or healthcare, growth investor. So that's the point. So do your homework and just try and tighten the funnel on who you approach. It'll save you a lot of time. Doesn't mean there's any guarantees in life. It'll save you a lot of time. And so again, those are the 2 things I can think about.
That's great. Wes, any thoughts?
Yeah, the one thing I'd add is distribution. And it sort of goes back to something Andrew was saying earlier about D2C and how it sort of lost its luster. I think that, everybody is now on the internet as a distribution channel. There's some stat that I'm going to botch about how Unilever sold a huge percentage of their, had a huge percentage of their business this past quarter online. So it's no longer a differentiator to say I'm distributing through direct to consumer. But if you can really think through distribution and how it's going to get in your customers' hands and what sort of unfair advantages you have from a distribution perspective, either there's clusters here that are using X app, or there's clusters here that we can get to through our relationships with nursing schools, and really nail down how you can get your product in people's hands and how to make them care about your product, you're going to be in a lot better shape than saying my business is a retail business or my business is a direct to consumer business.
That's great. And I think something that you touched upon, Wes, earlier was, one of the portfolio companies you guys just signed, ran a bunch of early tests with a fake company, and just showing and doing some of the science behind the art. And it's honestly something that anybody can do. And it surprises me that so few companies and early stage founders do this, because they say, oh, well, it doesn't, how do I do that? I don't want to damage our brand. I don't want to pretend to sell a product that we don't sell. It's bringing the science to the art, right? If you can go to a venture capitalist and say, hey, my company is named whatever, Mouse, but I created some other fake company called Rat, and I tested 50 different products in front of them and in front of an audience, and I spent $5,000 on ads. And out of those 50 products that I pretended to sell, I sold, a ton of pre-orders of this one product. Everyone loved this one product right here. Going to you guys with that science is just so great, instead of being like, look at my vision for Mouse. Isn't it so beautiful? I have a wonderful designer who made this cool brand. It's not bringing any science to the forefront. They didn't do any work. They just thought of a brand. And now they're coming to you guys to do the work and say, give us money so we can then go out and figure out our distribution. But there's absolutely zero reason why you can't set up landing pages, sell pre-orders for a fake company, do some of that science. When people make those pre-orders, do your best to fulfill them, or tell them, sorry, we're sold out. Whatever it is, your fake customers are not going to be that mad, nor will it damage your brand because it's a completely different company. But that's just one example of an easy way to validate your product, and then also show other people that you took the actual science to validate your product, instead of just saying, trust me, everyone's going to love it. My idea is the best. Prove it, put some science behind your idea. What KPIs do you look for in early stage companies that are good indicators for future success?
I'm going to let Wes start with this one, since he's the analyst extraordinaire.
I appreciate that. I'm not sure where to begin. It's definitely a tough question because it is so early, and people might think something like CAC would make a lot of sense. How much are you paying to acquire a customer? But due to marketplace dynamics, your CAC now is not going to be the same as its scale. Although it might cost you $5 to acquire a customer now with $100 in ad spend, when you bump that up to $1 million in ad spend, it's definitely not going to stay at $5. So that's not necessarily the right way to look at it. But what I can say I think is super valuable is what happens after you acquire that customer, and what's their propensity to both share their experience as well as come back to buy more of it. I think that generally is something that stays more constant over time if you can deliver the same quality. So if somebody is buying your shoes for $5, that's great. But if you say that person that bought it for $5 that went out and told 3 other people about it who also bought shoes, and then 6 months later they came back and bought another pair themselves, that's a super compelling story that I can't wait to learn more about.
Nice. So almost if they can prove out some level of a referral mechanism that's been happening naturally because people really enjoyed the product.
I think there's sort of manufactured versions where, it's $10 if you refer your friend, that I'm not as keen on as the natural. Your product is that different and that special that people will tell other people about it because there's social currency in the product itself. Allbirds, I think, is definitely one of Andrew's best investments and Brand Foundry's best investments. I think that's a really good story of how people could not wait to tell other people that they actually liked their shoes and that they were comfortable. there was like value in showing up to work in Allbirds and like, yeah, check these out. This is ridiculous. And I think that Clove is another example where that's happening right now, where nurses are tired of being on their feet all day in clogs or Crocs and saying, wow, there's a company that actually took my needs and made it better for me. And I can't wait to tell my coworkers who are going through the same thing. So those are the examples. And that's sort of the thing that I want to see more than like, by only incentivizing $20, I got this guy to send 6 emails. Although that is great too. And there's a place for it. It's just not necessarily what I'm referring to.
Makes a lot of sense. And like, how can someone prove that to you guys that there is, because obviously there's anecdotal evidence and, you know, sometimes I'd imagine very frequently when people are pitching you, you might assume that they might be sort of fluffing the reality a little bit. Everyone's talking about this. Everyone wants this. Trust me, give me $1 million. But like, how can someone prove to you that there was this sort of like referral mechanism before they're coming, or while you're in the pitch, like whatever it is, like how can they prove it early in the process?
Well, yeah, I'll jump in. The good news is once we're launched, you know, you've got the 3-month cohort, 6, 9, 12. I mean, you're gonna have data you can just easily pull, and you're probably gonna have either an internal digital marketer that's gonna have some kind of dashboard or an outside partner. A lot of times, one we've partnered with, so we've got the trust there anyway. So I mean, that's the easy one. We've got the data. I think, you know, a pre-launch business or seed stage business has yet to launch. You know, we're going to hypothesize about a CAC to LTV ratio. We're going to factor in an average order volume. So if it's high-end designer shoes for $300, it's probably the chances of a high repeat rate are probably small. They'd probably be, you know, 1.5 times per year. Versus, you know, LOLA feminine care or, you know, Cake, you know, wellness products for men, where there's kind of just a higher velocity. So we're going to hypothesize there. Now, because we have, you know, a lot of experience, there are certain rails that, you know, CAC usually falls into. House plans, commodity items. You want CACs probably, I don't know, between 10 and 25. And then certainly you want the ratio of the CAC on the higher end products to be, you know, probably in like the 40 to 70 range. Again, a very wide rails, but, you know, and then the other thing that you're going to factor in is that most of the time, you know, you're going to want to spend between 20 and 30% of your revenue target. So if you're doing $100, you know, per month in revenue, you've hopefully spent between, you know, well, nothing to no more than $30. So again, there's variations depending on the product and the category and the order value, but, you know, again, we've got just a lot of, you know, rails set up to help guide us.
Makes sense.
I mean, for example, I mean, the easy thing, and I'm just getting literal on purpose. I mean, if you're selling organic tampons like LOLA, there's a plug because we love them. You know, go to your nearest Walmart for product. You know, their ticket for one box is $12, right? Or 19 with a 2-for-1. So, you know, if you're spending $100 of customer acquisition, it's just a bad business model, you know? So, you know, it's not hard math, and we've established a lot of the integrity of the lanes with which to stay in. So.
Okay. And yeah, that makes a lot of sense. Wes, sorry.
Yeah, I think to add on to like what to do as far as coming up with those numbers and knowing we take it with a grain of salt is really comes back to that initiative piece to me. You can be pre-launch and tell that story through initiative you've taken and tests or initiative you've taken and talking to the right people and testing out different distribution areas. Generally, one of the ways that I've seen it presented that I've really appreciated is like zip code level or hospital level analysis of like, I think hospital is the easiest one to describe, but if you sell into, you know, University Medical, one pair of shoes and 6 other people buy shoes from University Medical without, you know, an increase in ad spend, you know that people were talking about it at University Medical. So I think that those are the sorts of stories that founders have to take initiative to develop and present in a way that makes sense, that can be validated.
Makes a lot of sense. And sometimes you don't even need that. You don't even need your digital marketing to kick off. Like I talked to a company not too long ago that did supplements, and I think they just raised about 4 or 5 million just recently, and they went door to door to bodegas and just convinced, maybe 1 out of 20 bodega owners to carry their stuff, and that was a good testing ground for them. And if you sell shoes, if you sell any other kinds of products, go to your local stores. Hopefully, talk a couple of the boutiques, whatever it is you're trying to sell, beauty stores, whatever it is. Talk them into selling a couple of your products first. You don't need this like whole roadmap of like, oh, we're going to get from 0 to 1 million in like a couple months. Like, start small. So I love that. Thanks for jumping into that there. And great plug for LOLA. And I talked to Wes that we worked with them too. And I think Alex is like one of the nicest founders in New York. So that's cool.
You bet.
Here's a fun one. How does COVID impact the current D2C landscape? Does it affect your criteria for investing in the future, or is it affecting anything you guys do currently in terms of your investing?
Yeah, no, I think we can expound on some of these if we want to. But I think 3 initial big shifts: certainly e-commerce over stores, products over kind of in real life experiences, and the digital connection over in person. Probably all literal in their own meaning, but we can expound on that if we want. But in terms of just investing in the future, I think you just have to be mindful of what categories. Service businesses like dentistry, short-term effects, wedding, just a terrible sector to be in. That probably has ramifications longer than dentistry. Obviously digital first brands have been excelling, just given, necessity, essential businesses, so forth. For Brand Foundry, we've stayed aggressive. We're aggressively pursuing new investments. Founders are still finding us. We're still pursuing them and building relationships. I mentioned at the start of the, I guess the Zoomcast, or the start of this, we won a deal last week in San Francisco, and the entire relationship was built over Zoom. And funny enough, one of the founders went to Wharton. I guess that's a Wharton plug. We love Wharton. I have a couple people that help us. We do like Wharton. We like a lot of MBAs. We like people. But nonetheless, I went to school with Joey at Allbirds. So, a very small community and a good reference. So I think, again, we're staying aggressive. We're in pursuit of differentiated, brands, products, and technology in categories that are very large. And, we probably won't do as many that are focused on corporate. I mean, we ran into a pretty fitness, kind of bring the fitness through a mobile. It's pretty cool. It's a guy based in San Francisco, and it was like an RV with like, put the doors down and this whole like Peloton thing. I was like, oh, this is pretty cool. And I was like, all right, who are you serving? And he said corporate parks. And, we planned on talking to him again 2 weeks later, COVID, and just said, hey man, wish the best, but no one's at these corporate parks. So we're clearly gonna wait and see. So certain sectors, certain categories, it's just kind of trying to understand how to de-risk those investments.
Makes a lot of sense. So I guess if someone was hit pretty hard and they're just by happenstance or unfortunate circumstance, it might not be the right time.
Yeah, and there's wild stories. We had 2 companies raise, one raised 15, one raised 25 million. I mean, literally 2 weeks before COVID, and just it's everything's diligence and this, and then all of a sudden COVID. We've had other brands have to reopen rounds from a previous year just to bridge forward. I mean, there's all just a bunch of stuff going on. I mean, our sentiment with the broader VC community is that a lot of people have dry powder. They've got the money, whether they're as aggressive as us in their pursuits, that's up for them to decide. But we all have investment periods with which to deploy the capital. And so, we think it's a really good opportunity where a lot of the pretender entrepreneurs are not going to move forward. It's a tougher climate. It's tougher to raise money. It's tougher to build a business. That's grit. I mean, let's find one another and do business. Let's go. You know, and you can kind of look back at, 2009 to 2011, and just after the financial crisis, I mean, a lot of really awesome businesses were built. And then something that we tell LPs that might be a little skittish, like, what's your outlook? Well, if we're funding a business today, we're giving them enough money for 18 months. So, we're not necessarily correlated with the stock market. We certainly don't want a recession. We're certainly not economists, but I mean, what's going on in 18 months? So you still have to fundamentally build the business the same way, have the grit, run and gun, but this is long-term investing. So, I mean, these outcomes, Peloton for me was a seed investment in 2011, obviously went IPO and is now a $10 billion market cap. Yeah, it's a long time. It's a long journey. Allbirds, which is, I've never seen velocity and growth in my lifetime as fast as that. Was a 2015 seed investment, and it's as awesome as it's been and as fast as it's grown. It's been 5 years. So, this stuff takes time. So I don't know if Wes has anything else.
Yeah, I'll touch on two different things quickly. One is throw Webb Smith and 2PM a shout out because of some logic that he's really pushed forward around what happened in China after SARS, as far as the lifting of all boats via e-commerce tide that happened during that time period that we're starting to see now. I think some of the stats that I've read are that close to 50% of retail happened on e-commerce over the last month or so. And really that's something that's going to lift everybody up and should help everybody's e-commerce business, support the missing link that was in-person retail. And we're really excited about what that means over time, as I think more people getting engaged with e-commerce is going to be great for the business in the long run. I don't think everybody's going to go back to just, in-person shopping after this is done, and really excited about what that means for new brands as they enter into this new world with a lot bigger TAM, people shopping online. I think besides that, to echo something Andrew said about where we invest and what it means is, even if there is a recession after this, and I imagine that there will be, we're not building businesses that are looking to, sell in 18 months even. We're looking for businesses that are really going to be a part of the ecosystem and fabric of our lives in 5 years and 10 years. And with that timeline in mind, it doesn't make a ton of sense to be very reactionary to economic trends. We can't predict how deep the recession is or how long it will last, but I can promise you American ingenuity and American progress will keep marching forward, and that in 5 years, 10 years, we're going to have some amazing companies that were started during this time of hardship.
Yeah, and probably more creative ones too. As certain industries get tougher, people have to think a little bit further out of the box because they want to be entrepreneurs, but maybe whatever idea they had 16, 18 months ago just aren't exactly the right ones for today. Makes a lot of sense. For a new firm starting out in early stage startup investment, what is the best way to meet companies and founders to invest in?
Without a doubt, it's the classic warm intro. I mean, it's a very small world. And look, we get a lot of, I'm not going to say don't try the cold email because you never know. But I think VCs and investors get a little bit of a bad rap because, we don't maybe respond to a cold email. I think I'll give you two reasons why we don't. One, we get a lot of email. If you can imagine, we alone have 53 current portfolio companies where anyone can reach us at any time. We've got investors, we get a lot of email. The second thing is, if you approach us as a cybersecurity business and our name at the header is Bill and my name is Andrew, I'm probably not going to respond. I'm trying to be dramatic on purpose. So, take the time to at least, tighten it up. Mention someone's name. I mean, so I'm all for the cold email, and I've honestly cold emailed LPs, and it's worked, not a lot, but it works. So, more power to you. But I think the reality is, it's the warm connection. It's not bombarding you through LinkedIn. LinkedIn is a cesspool, in my opinion. Definitely has some value, but there's enough people through any university, any marketing agency, just spend some time to just see how you could get to us. And just, that helps immensely. So, again, I think, just show some hustle and try and get to us like through a warm intro is probably your best bet.
Makes a lot of sense. And just out of curiosity, when of the companies you have funded, like how many of them have come from other venture firms saying like, hey, we're putting in X amount. Can you also put in X amount as well? Because I would imagine that's just like a much quicker kind of process for you guys. Well, because you've gotten a vouch from someone else you trust who is putting down their own money. But I'm curious how of your, like, obviously maybe you don't know like right off the top of your head, but ballpark, like how many come from something like that, another investor? And then how many come from something outside of another investor?
Yeah, it's not a good percentage. I mean, we're actually looking at a deal right now that came from a really friendly fund in New York that we've done plenty of deals with. I mean, they're leading and invite us in to participate. And so we're reviewing that deal. And again, the example I just used from last week when we won the term sheet and negotiated was, she went to business school with Joey at Allbirds. So those are founders and intros from founders we've backed in the past are the best deal flow. They've got a pretty good lens. They went to school or, built a business with them and have a good sense of what they're doing. And again, other firms. So I don't have a good percentage, but those are two, very good sources of deal flow. One thing, just for humor's sake, that is a good suggestion not to do, if you don't mind, would be, if you're a startup, please don't hire an advisory firm or an investment banker to reach out on your behalf. That is pretty much 99.997% probability of going just automatically to delete. So please don't do that.
That's actually interesting to hear that. So I was working on an early stage product years ago with a few different founders in the ed tech space. And one of the people who I ended up meeting was a chief of staff of a very, very famous politician who was one of the top 2 politicians in the country. He was the chief of staff for this person. And he said, well, hey, we'll get you all the investors you guys want, but by the way, you got to pay me a $10K per month retainer. And that's just ongoing for quote unquote business development. And I'm like, this guy is very Wikipediaable, very Googleable, like very high up there, was a chief of staff for a very famous politician. And he wants a $10K a month retainer for intros. Part of me, I was young, I was sort of like, oh, cool. This guy's up there. Luckily I didn't take it, but that's good to know from you guys that offer is kind of not going to work out.
Yeah, someone chatted. So I think, let's just try and answer that question. I think the question is, if you're trying to get into investing at seed, and let's just call this person an angel investor, what's the best way to invest? Again, it's very much a people and relationship business. Look, we're very open to anyone investing with us if they can show some value and have a good reputation. So, how do you meet us, right? If you're a current or if you're a new angel investor, I think it's the same thing you would try to do as a founder. I mean, you'd connect with us, you'd get a warm intro into us. You'd email us and say, hey, look, I've invested A, B, and C. We're going to probably look at a track record. We're probably going to look at, where you've come, how we know you. But again, we're totally open. We want anyone to invest, anyone to sit alongside of us on the cap table. That's friendly, that's hungry, that's, that adds value. I mean, look, I built a reputation, fortunately, a little bit of right place, right time, and having conviction to invest, and sometimes making decisions after one call. That's a choice. But my initial check sizes when I got involved as an angel were 10, 25K. That's a lot of money, but it's not like $1 million that the fund typically invests today. So the point is, be less concerned about the amount of money. If you can just demonstrate conviction and be helpful and work hard, people are going to remember that. Like, oh yeah, Susie Q was awesome. I mean, she was only invested for $5,000, but like, I've got this new deal. Let's get Susie Q back in this one, And so I think that lends itself to just, if you want to be an angel investor, you got to take it seriously. I know you're probably in to make money, but most people that do are trying to build a career, if not a business. And those are the kind of people that we would welcome in, probably more so than just a nice person that's got, 25K laying around. So even more specifically, how could you be helpful? Connecting, leveraging your network, suppliers, agencies, anything that can bring a new customer into the brand or help the team with, building of the business, that's helpful. And two, one or two simple cases. I mean, look, when I was an entrepreneur, I had all this supply chain experience in the health and beauty space. And so, the Harry's shaving cream, literally the formula is my formula, that I worked on with a third-party manufacturer in like 2007. So when Jeff and Andy came and said, "Hey, look, we're building this thing," one of the questions I just happened to ask him was, and sorry, the date was, I think, 2010 when they were thinking about launching the business. Who do you have? What's your supplier? Who's your supplier for the tubes? The deodorant, the shaving cream, and so at that time it was a smaller check for me, but I'm in, and I was able to be resourceful. So. Anyways, just another case study and point to drive home on, if you want to angel invest, be a good person, work your way in through the relationship somehow, be credible, and just, stay really active and hungry.
That's awesome. And in a rule of thumb I have, if you are going to be bold and cold email, because Andrew mentioned like most of the time it doesn't work, but most of the time the cold emails you get are garbage. They're copy paste. And Andrew even mentioned like sometimes the wrong name is in there, whatever it is. My rule of thumb is if you're sending a cold email to someone, it should take you no less than 30 minutes to write that cold email. You should be Googling everything you can about that person, finding every piece of information, if not to impress the person, just to show them that you even like looked at them, right? You knew who they were, you've done your research, whatever that is. And most people who are at a certain level in their career are mildly Googleable. You can find something about them. I was commenting to Andrew before we went public with this Zoom. He's oddly not very Googleable. You don't find very much online about him. But again, you start going through a rabbit hole and you will find enough information to populate that email with at least something so they'll at least notice, right? Like, even if they don't respond, just, you could know that you at least put your all in there instead of like, "Hey dude, I've got a great idea. I could use 1 million. Just not even really caring, or just don't template like an email and send it out to 20 people. Everyone knows that it's templated if there's no personalized information, and never ever use an ink, like one of those LinkedIn auto like series sort of products where someone is just getting templated emails 5 times over. You're just going to look like a bot. But yeah, I mean, if you're going to go for it, put the effort in. And 1 out of 10 people you email, out of the 300 minutes you spent on there, I have to imagine at least 1 will respond to you at the very least if you put in that effort. Oh, interesting. It's cool. We're getting like people from all different angles here. What is the best way for an agency/consulting firm to show value and work with you and your portfolio companies?
I mean, I think the easiest way is we're going to probably lean on case studies. What brands at this stage of your work with, and just make us feel comfortable that you should be invited into call it an RFP. If you come through us, that's what we're going to look for. Like, yeah, tell us who you've worked for and why you're potentially better. I mean, look, it's probably like a 10 or 15 minute call because we want to just qualify you a little bit, but certainly want to tee that up for the founding team to learn more and make the decision. We're certainly not going to make that decision for the founders, but want to make it credible enough that if we do intro you in, we want to, we know enough about you and that it makes sense. I wouldn't necessarily think you don't have to be like the lowest price offering, but just Tell us about your online experience. Like what companies have you worked for? I mean, most agencies, there's all these logos and PepsiCo and like everyone's got the same thing. And you're like, all right, well, what did you do for PepsiCo? Like, hey, Kellogg's, I mean, you know how many agencies they've got? They probably have, 150. I mean, and that's fine. Tell us what you've done for early stage startups. We're happy to invite you in and please, reach out.
Yeah, I'll second that, because the way that this meeting came together was actually through connecting with a niche via somebody else. And what I would say the best way for you to show value and sort of become a partner and somebody that we want to recommend is do a really good job and build a reputation of being a really good person and a great person to work with. It came from Greg Fitzgerald, who I had connected with through somebody else talking about how great he was. And he just said, Anish is just such a good guy. He's somebody who can bring a ton of value to your portfolio companies. You definitely need to meet him. And if you can get that sort of bringing endorsement, especially from somebody that we trust and respect, of course, we're going to want to bring you in and involve you when there's an opportunity to.
Awesome. Yeah. And karma goes a long way. Do something good for someone, do something good for someone else. They'll come back around, or even if they don't, whatever, you can at least, again, it's kind of like the cold email example. You can at least know that you did your best, and, just keep it going like that. Grace, was that the last question? Okay. We have one more question from the chat. How can a new seed investor meet founders to invest in?
Yeah, I think Andrew touched on that.
That's the holy grail, man. That's the holy grail. It's like when an investor, we'll give you a serious response in a second, but like, that's like an investor saying like, where'd you get your deal flow? I mean, it's not like we're typing into Google, like, oh, like veterinary care. And, no, it gets back to the people aspect. I mean, look, we've been doing this for 10 years and, we may have had a conversation 7 years ago with some person that circles back today. You got to just network your way in. Like, where do people, I don't think you have to go to all these demo days, but again, if you were thinking about what's the best use of your time, you could either sit at home and crank out 3,000 emails to try and, get in, or you could say, look, most consumer investors go to this conference. Most consumer investors go to this demo day. They go to, an event, there's a coffee shop most VCs go to in New York City. I mean, you gotta get creative, but 1 + 1 = 3. So I don't know if that's a great answer, but it's the most real answer I could probably offer. Wes, do you have anything?
Yeah, just echoing that and echoing what Anish said of karma goes a long way, and being loved and respected by your peers. They'll want to bring you in and get you involved. So, Andrew, I think, has done an unbelievable job to date of building up a reputation from Brand Foundry, really just through, not from events like this. And to Anish's point, it's not easy to Googleable, but if you talk to any of our founders, they're going to say, yes, absolutely work with Andrew. He does an unbelievable job, and Brand Foundry is there when we need him most. And that's how we get our deal flow at the end of the day, is people want to work with you if you treat them well.
Yeah. And it could take years to build a network that compounds itself. So I don't know. People ask us how we got all of our clients. And I kind of just say that the beginning start of it is, and it might be kind of similar to you guys, how you sort of just meet more people who are exciting and interesting. It's just get coffee with everyone you know. Out of 5 people, maybe one of them introduces you to another person. Start that process again. It's, if you want to build a business, and this is even if you're on the consumer side, if you're even building a normal startup, you need to be well connected. Like you need those connections for so many different reasons, for hiring, for knowledge, for someone who could introduce you to someone who can build your supply chain, who can do a million different things for you. Like you can't just be sitting at your desk being introverted and not talk to anybody outside of whatever your tunnel vision is. So if you want to do anything remotely entrepreneurial and not just be stuck to your corporate job or whatever it is that you're doing, like you got to get out there and meet as many people as possible. And yeah, the other thing I've learned is you have no idea what or who of the people you meet are going to be the ones to introduce you all around. I would say half of our business right now is literally attributed to one person I met, and that's a person I cold emailed. So yeah, you got to get out there, get away from your desk. Anything else you wanted to kind of add into that one? Cool. We're out of questions now. I don't know if there's anything you guys wanted to plug. I think you guys gave a good rundown of your firm and everything else. Wes might want to plug his favorite soda or whatever he's drinking over there. But yeah, I don't know.
Weather
if there's
20 for a discount code on weatheru.com. Give it a shot. It's a really delicious, sparkling CBD beverage.
How do you spell that?
20%.
Weather, Weller. And I'm also putting on some Starfish right now. I want to plug them too. It's an acne company for Gen Z. So trying
Nice.
to show all of our products off. It was a really great time. Thanks so much, Anish.
Yeah, most definitely. This was awesome. Thanks both of you guys for spending your time here and teaching, this squad of 40, 50 people who showed up for this chat, a ton of new knowledge. Thanks a lot.
Yeah, had a great time. Thanks for hosting. Appreciate it. Thanks, Grace.
Bye. Thank you.
Nish, thanks, buddy.
Absolutely. Thank you guys for coming.